Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Let's dig into a few sectors that really tell the growth story, or the lack thereof, of this country. Consumer staples, i.e. many of them grocers, that we're going to talk about mostly, telecom, and utilities. Now there are shifting sands beneath two of these sectors, both of which are at the forefront of what is discussed as a so-called industrial revolution. The other, grocers, are life-sustaining and they are the quintessential consumer staple. So we're going to be diving into what is the investment case for each of these sectors with Fidelity Equity Research Analyst, Andrew Hall. Welcome, Andrew. Great to see you again. How are you?
Good to see you. Doing well. Thank you.
Good. Great to have you joining us right here. All of these sectors bring in an awful lot of, or strands that we can take out of data that keeps rolling in. We've had lots of US data out this week. We've had some Canadian data out recently. We're saying these sectors tell certain stories of growth in this country. What are you noticing in the data right now? I'm sure you're reading this voraciously.
Well, I think what we're coming into the year is we're only halfway through. It feels like a lot's happened. And there's been so much volatility in terms of the headlines, tariffs, will they, won't they on the tariffs, how much, what are we going to do with partnerships, trade, we had an election. There's a lot of volatility going on, which is making the numbers, everyone's waiting on each next data point. But I think so far in total, if you take the trend, what it's essentially in Canada is telling you is it's a continuation of meh to not great from a GDP or consumer spending standpoint. Unemployment has been relatively stable over the last 6 months, but stable at a higher level than you'd like, close to 7%. And then on the US, I think it's been a story of weakening consumer from a very healthy standpoint. Like they started at a healthy starting point, better than Canada, and you've seen a general weakening in that, but not nearly to the levels that maybe some of the consumer sentiment indices would have told you they might when we were in April and the peak fear around tariffs was coming on. And so, I wish there was a more dramatic story, but it does feel a bit that despite all of the volatility, we're ending up in not that different of a place than we were 6 months ago.
That's fascinating. There is a bit of is it muddling on, or it's actually pretty good to see that we're not that much different versus, is it more than just sort of meh, actually, when you think about it?
I think that given some of the headwinds that are going on, particularly the tariffs and the risks around that, I think you can be sort of breathe a sigh of relief if you're Bank of Canada or a government. But that doesn't mean there aren't challenges, right? Sure. I think we recognize the lack of investment, lack of productivity growth in Canada as a long-term kind of sort of more structural trend, and trying to reverse that is still an important thing that people need to do a better job of.
So we'll talk about some of the shifting sands and maybe an industrial revolution, which we'll get to in a couple of sectors. Let's begin with consumer staples, particularly grocers. This is something that you follow very, very carefully every day. I mean, we all do because we're going up and down the aisle, so we sort of notice some of these things. Actually, they've been just fine throughout many months here.
We were just talking about before the show about how indices essentially today are coming up to record highs on the S&P 500. And yet, if you look at year-to-date performance among the grocers, all of them are beating the indices, whether that's the TSX or the S&P 500. These have been good quality companies for a long period of time, long track records of growth, being able to balance uncertain environments, whether we had peak inflation in the 2022 to 2023 cycle, the COVID pantry loading. And I think the environment we're in today is kind of closer to that sweet spot where inflation is higher in food than it is in general inflation. So for last month, I think it was around 3.4% for food inflation versus 1.7% for the broader index, which is a good place for the grocers. They love to see inflation kind of in that 3% range. If it gets higher than that, you start to get into the headline risk, start to get into the political risk that we saw in 2022, 2023. And obviously, if you're below that, it becomes that much harder to cover your wage investments, your technology investments. But 3%, 3.5% food inflation, they're very happy with that.
Okay, so we should buy the groceries, complain about the prices, and then just buy the stock so that we don't worry about it too much. Tell us a bit about how the Buy Canadian everything, particularly within the grocers, has it meant anything really to the bottom line? How have they handled it?
I think like a lot of things in our world now, you're kind of trying to parse between the social media reality and the front page of the news and what's actually going on in moving fundamentals. And certainly if you listen to the headlines back in February and into March, you would have thought this could be a big challenge to try to manage some of the inventory issues. look, here's a full shelf of apples that are all going to spoil because they're from Washington State, and the Canadian ones are all gone, so now you're not going to sell that incremental apple. The reality is the most important thing in retail and in grocery is always price, and there's a clearing price for those types of inventories. People are ultimately value seeking. They want to see price. So, there is a subset of consumers who are going to buy Canada no matter what, but there's a lot of people who are just trying to feed themselves and their families. And so there has been a product shift. We have seen outsized growth in Canadian sourced products over US sourced products. But if you were worried about any kind of complications around increased spoilage or shrink, all the grocers have been able to handle that.
That's really interesting. So it's because that must be quite costly for them to have to handle that, and then it would filter through ultimately to issues with profitability, but it has not.
And I think that the other thing too, right, is that as usual, it's sort of an integrated story where the grocer's at the front end of it, but you've got your suppliers who want to still sell their product as much as they can, and they're working with the grocers. We've seen some companies make announcements around, okay, we used to supply from the US, but we can actually do it from Europe. And yes, the shipping's a little bit more expensive, or there's a time difference, but that's better than a 25% tariff or 10% tariff. And so you're seeing all this kind of underneath the surface that generally I think we all kind of recognize when we go to the grocery store. Other than the labels on the made in Canada products, the experience is pretty much the same as it was 4 months ago.
So just dive into the suppliers a bit more. So these would be suppliers that are from elsewhere, or not maybe have manufacturing facilities in North America and maybe in the US, but they're global companies?
That's right. So there would be a mix, obviously. I think in general, the way to think about it is direct source products from the US for grocery is around 15% of their kind of sales mix. And a lot of that would be produce and items that are hard to replace, particularly on the sort of the seasonal shoulder periods, winter being the big one. And then kind of outside that, more shelf stable, a lot of the things, even if they're US brands, they very well are likely to be produced in Canada. And so you're able to generally kind of shift and make it work behind the scenes. And I think, in general, the shift hasn't been so great that the companies haven't been able to handle it.
It's like something that we put on our hamburgers and hot dogs on a Canada Day barbecue. Like those types of things, we can find the Canadian producer of that, even if the label is
it might be elsewhere. A US brand, but it very well could be produced in Canada.
Okay, that's really interesting. When you take a look at how food is shifting in terms of the suppliers in Canada, I'm just sort of carrying on from what you said. Are we seeing more and more, I don't know, new creations, new names, new pop-ups? Like I see new strawberries that seem to have come out of nowhere. Are there new companies working towards this in a more meaningful way that are investable?
From an investable standpoint, I don't think we're seeing any small cap public equities that are specifically doing that. I think probably the biggest beneficiary in terms of when you think about that product shift is actually just the private labels that are owned by the grocers.
Okay.
Their own brands.
Right. Their own brands.
If you look relative to the global retailers, Canadian companies actually have, that's probably what they're most well respected for in a global context, is some of their own brands and how much penetration they have on those. And so it's very easy to make that save and switch, and it's made in Canada kind of argument on some of their own brands versus a US national brand.
Okay, interesting. What does all of this tell us about the consumer itself in terms of health? So groceries are strong, we have to buy them, it's doing well for the grocers, there's a little bit of inflation. The consumer health itself, we know they're grappling with the story of mortgages through this year and next, particularly, and overall inflation. How do you put consumer health?
I think in Canada, as I said off the top, it's still a challenged environment. Like, it's more challenged than not. I think you're still seeing that in some of the more discretionary retailers that sell apparel or seasonal goods. Always within apparel, there's always going to be a winner because there's always a brand that's doing really well. But if you think more broadly, it's generally a challenging backdrop for companies like that. And I don't think, again, it's not maybe the worst of what we feared back in April, but it's certainly not pointing towards any kind of euphoria like we would have seen coming out of the COVID lockdowns. Okay,
really interesting. Are there actually analogous things to that, though? I mean, there was a bit of a crimping of basically buying anything and being careful about things at that time. Is there anything analogous? Because we've been talking about this sort of V-shaped as being somewhat analogous to the consumer sentiment story around COVID.
Yeah, I think from a very short sentiment standpoint when you think about the period of peak concern around the U.S. tariffs. But it's such a blip, and it's definitely not the same magnitude as COVID that, again, we were talking about trends versus those individual data points. You'd be hard-pressed to see it on a 3-month basis. Yes, you did see some choppiness where maybe there was some pre-buying and things like autos ahead of April, bit of softness after that, but average it out 3-6 months, it doesn't look that different.
Are the companies that you're following in terms of grocers, but across the consumer space, do they have to rethink how they're dealing with CAD? We've had a stronger Canadian dollar, the US dollar, actually it's off a bit now, was up a bit, was off a bit, but it's generally been down trending. Do they get to rethink? Is it useful to rethink their currency positions there? Or
I think, as we touched on, if you think about 15% or so of the mix, now obviously their suppliers would also have inputs from the US, so the CAD is more meaningful than that. It probably did contribute somewhat to the inflation we've seen over the last couple months, and then maybe that does give them a little bit of a lower inflation, coming up, but it's probably not big enough to really drive the underlying inflation rate all that much different.
Let's dip into the discussion of telecom. So telecom, actually, the headlines at the moment, you see just a lot of asset sales. There's a lot of momentum and deals and asset sales and so on. But what is the biggest trend that you've been watching through telecom over the course of, I don't know, the last year or so?
Yeah, I think the asset sales get a lot of headlines, but typically I think when you see companies making announcements around asset sales, it's an indicator that there was stress.
Yeah. They're trying to
industries that are thriving aren't typically making big strategic changes like that. And so the big story in telecom really over the past 3 years has been a nascent competitor, challenger brand that was really backed, not explicitly, but by the government wanting to increase competition. So a regulator that wanted to increase competition, and this new fourth player in the market that really destabilized things from a pricing standpoint. Pricing has come down. My phone bill's lower. I think most of our viewers probably is as well. And that's been the big story that took what was intended to be a staple-like sector and bring down the stocks because they had too much debt effectively to really handle that. And that's going back to the asset sales point. I think the story now is there was this big immigration tailwind that helped offset some of the pricing pressure. That's effectively gone. If you look at Q4 or Q1 net adds, new subscribers to the telecom companies, there's definitely been a slowing. And so it's even more incumbent than ever for pricing to get better. I think it's early to say much has changed. I think the rate of decline is probably slowing just inherently because we've moved so much over the last 3 years. But it's still kind of early to say the all clear. The most promotional period of time is always that back to school and then into Black Friday, Cyber Monday. And so really how that shapes up could be an important indicator.
Why is back to school such a big deal for telecom?
I think that there's just, that's historically when people have been trying to get their subs. Typically quarter end is always an important period, even Q1, Q2. And around the holiday season, maybe there's fewer people sort of doing that. And so end of summer into the fall, it just always has been. But you're right, there's not a great reason why that's the case.
Here's your new running shoes for school and a cell phone. But anyway, that's the way it works. It's really interesting. So you'll be watching that, I guess, carefully to see whether that picks up and then it goes forth through to Black Friday and that sort of that area. In terms of regulatory, any major shifts that actually quite a lot has been discussed. I don't know if there's anything you're looking to drop in as actual regulations at this point. There's nothing major, is there?
So I think that, as I said, the push from the regulator has been to try to increase competition, reduce prices, and a lot of that's happened. And there's been a push from industry now to say, all right, enough. And again, when you think about the new government that's come in, wants to invest more in Canada, wants big infrastructure projects, the telecom companies want to say, hey, we've been spending a lot of money laying fiber, increasing the performance of our networks. Up to this point, and we're only a couple months in since the government, the new cabinet was formed, no change really. And the latest CRTC decision just last week was uphold the exact decision we made 6 months ago, and the telecom providers tried to push back and basically appeal, and they said no, this is the rules of the road going forward. So no change yet. We'll see if their lobbying changes things. I wouldn't expect much of a change from the stance of the government. I think it's too easy of a win to be fighting for the consumer side. But but maybe on the margin, things aren't getting worse anymore, which it was a headwind for 2 years.
Okay. I was gonna, is that the investment case?
I think the investment case is generally, wow, the stocks are down a lot.
Yeah.
Valuations have come in a lot, and maybe things can just stop getting worse.
Yeah.
But I do think that the challenges on the immigration front, what that means for your long-term subscriber growth, does present an incremental challenge.
Okay. Less bad is good, but is it good enough? We'll check back in a little while. Within utilities, which you follow very carefully, I mean, there's lots of stuff going on here, and it does appear that we either do have new regulations or there's a lot more that seem to be in the hopper in any case. We never stop hearing about nuclear. This is the main theme story within utilities, presumably the pivot, and it might be a long-term thing, but to nuclear.
Well, I think what we want to do is back up a little bit on why is nuclear now such a big theme, and that's really what's been the biggest theme in the market over the past 2 years, 2.5 years. Of course, it's AI
data centers,
and data centers, and we need a lot of demand. In 2020 and 2021, all the big tech companies made commitments around carbon emissions. Nuclear is really the only incremental carbon-free baseload power that we can add.
Stable.
Hydro's mostly tapped, exactly, the baseload component to it.
Yeah. Is that what baseload means?
Exactly.
Stable. Okay. Oh, now I know.
We can turn it on and then it works, right? Whereas if the sun's not shining, if it's not windy, solar and wind are more volatile, and so that's been a challenge. And I think that we basically reversed from, if you go back to Fukushima, 15 years ago, no new nuclear. Western countries were shutting down nuclear, and it's totally been a reversal. I do think that there's a lot of enthusiasm, but we do need to caution nuclear projects are extremely complex. They're very expensive. The US just completed 2 new units, Vogtle in Georgia, and I think it came in several years over time frame and billions of dollars over budget.
Right.
And so the kind of curb your enthusiasm around how early some of this stuff can happen. We know that Eglinton LRT is still not open. It was supposed to be open 4 years ago. These are major projects, just like that, where early 2030s is probably still early. Mid-2030s, late 2030s, probably more realistic.
If you have a hyperscaler or 7 sitting on you saying, we just have so much cash flow to give to this, make it happen, that makes a difference?
So up to this point, none of the hyperscalers have signed up for a brand new reactor. I think, again, because it's sort of that, I'll take the 3rd reactor.
Sure.
Because the 3rd reactor is going to be a lot cheaper.
Right.
And no one wants to take the 1st or the 2nd reactor. Everyone wants
the government do that.
Everyone wants the bronze medal.
Right.
And that's creating, I think, this sort of waiting game. So you're seeing things on the margin where you're signing up to restart an existing reactor, like 3 Mile Island.
Right.
But in terms of new reactors, large scale, typical baseload, I think there's still an ask from the government to sort of more backstop that, and then it should pick up. But again, I think this is going to be a mid-2030s story in terms of when there's reality around that. And then in the interim, we still need a lot of new power. And so there's been a lot of regulatory uncertainty around renewables, in particular, the sunsetting earlier of tax credits for solar and wind. That's probably going to happen whenever this bill gets, this one big, beautiful bill gets passed.
Yeah.
But I think that the demand side of the story is strong enough that there will definitely be winners and losers in that market.
Like they just need whatever power they can get,
and they can get it faster.
And so it doesn't matter if it's renewable or not. We need to throw as much power at something. So we'll put up a couple panels if we have to, or
for sure.
Okay.
And more than a couple.
And more than a couple. Okay. So for utilities, the big players in Canada, are all of them doing all of the above, which I think you were mentioning there? If they're not doing something quite new over the course of the last year, or going forward, or planning to, are they falling behind? Are they all engaged in some new, different forms of power generation?
When we talk about a big theme like this, the challenge is the basic vanilla utilities that are large cap in Canada aren't necessarily the easiest way to play it, because they're totally regulated. Right. And therefore can't necessarily participate in sort of new industries as easily. And so they're going to participate insofar as we need more transmission lines for the grid, whether that's electrification for EVs or data centers. They're happy with all of it. But the growth rates, we're talking about going from 5 to 6 or 7. It's not going to be a quantum of change just because of sort of your allowed ROE essentially constrains how fast you can grow.
Okay.
And obviously these are regulated things with the government. And obviously the way the companies are set up is effectively to lobby and try to figure out how they can get the government to let them spend as much as possible. And so I think that there's no clear winner in terms of the big regular utilities. And you're kind of going down into either the suppliers, more the industrial supply chain on nuclear, or looking at somebody that has an open position on power. It's not necessarily a regulated utility where power prices have been trending down for 20 years and now are seeing some signs of life. Those companies could benefit.
When you mentioned sort of the companies, essentially those that would be part of the construction side of things, which is more industrial, I guess, than utilities. But are there some that cross into both?
I think that there are some specialized suppliers that are really well known for doing primarily utility work. But you're right that in terms of my core coverage, those wouldn't be the companies that I'm necessarily looking at on a day-to-day basis.
Okay. So is the theme of nuclear and new power generation generally, is it priced in? Is it going to be useful to investors over the sort of medium term? Where do we sort of go with this?
I think that there's not that many places to play. There's not that many names, and that's inherently bidding up those few that can. I think that there's obviously some speculation in there that ultimately some of those companies are not going to be as successful as their spreadsheets say they will. Just like when we saw a wave of new EV manufacturers in 2021, and most of those aren't around a few years later. So I think on the really speculative end, it's tough. I do think that there are maybe a couple more established plays that can continue to work, but it's going to be, I think, in a bit more fits and starts. Right now, we're in the pure enthusiasm phase. If you take a really long-term outlook, it's probably really strong. But in the very near term, you're going to have those kind of fits and starts.
Okay, that's really interesting. Anything in terms of the smaller reactors? We hear a lot about these. They just seem a little bit more, well, something that would be up and running faster. What are the timelines? How much is that getting your attention? We, again, see these kind of headlines around the smaller modular reactors.
And so what I'd say on that is it always sounds great. I think that sort of like the third comment I made before, it is tough to be the first, and we're sort of waiting to see some of these new companies. Obviously, you've got some proven manufacturers that are doing sort of SMRs, that are maybe 1/3 the size of a regular one, and that's happening in Ontario, and they're trying to be first, and I think their timeline is the early 2030s. And so it's still several years away. I think that it's going to be sort of challenging for some of these really small companies that are basically a spreadsheet and a dream to execute on their timeframes. But I think some of the more established players that have a real track record, probably they'll figure it out. I don't think there's anything that says SMRs can't work. It's not maybe like certain other technologies that are totally unproven. We have nuclear submarines. Those are, in a certain way, kind of like SMRs.
Small.
Very
interesting. Yeah,
SMRs, but we have really, really small ones. This is obviously an in-between, but I do think it'll take time because you need to build the first one, and then the whole pitch on SMRs is turning it into an assembly line so that the fabrication work makes it cost less than a big facility that's a real one-off. And I think we are a long, long way from that being reality.
So the investment case, again, I mean, there have been lots of peaks and interesting things when you look at the uranium side of things and taking a look at where nuclear goes around lots of enthusiasm, which you were pointing out. Is it investable, or does it fall off for a bit while we figure this out?
I think there's probably...
What's priced in?
That's always the challenge, right?
Yeah.
Because when you see headlines like the U.S. wanting to start construction on 10 new reactors before 2030, that is a groundswell change. So I think there is a lot of fundamental backing to support this. And so, I think it's going to be mixed, like I said, for some of the more speculative players, but I do think there's still opportunities there that are probably more real. How
can Canadian grocers mitigate the impact of tariffs on food, and whether there's enough Canadian supply? So some of that you spoke about, but it's good to reiterate because it is kind of what people think and worry about, right, all the time.
For sure. I mean, I think that right now, a lot of the reciprocal tariffs that Canada had talked about, they held their fire on some of the most serious ones because the US held their fire on the 100%, 25% across the board. And so it's been pretty manageable. I do think that if we were to go with a full reciprocal basis, even not so much even just the grocery items, but cosmetics and other categories that have a higher skew those are going to be hard to replace in a short period of time, and that would potentially create a disproportionate inflation that would be harder to manage. Again, I think that the grocers proved through 2022 and 2023, when food inflation was running low double digits, people might not like it, but they were able to mostly kind of manage through it. And so it's likely they can do something similar. But I think it would create additional complexities. And I think the second part of the question around how much kind of Canadian supply is there to replace it. I think, again, there are certain products that you're going to be able to shift things around. Like we talked about, maybe instead of getting them from the US, we get it from Europe.
What do you do with coffee beans?
But there's a lot of things that you just can't. You just can't in a short period of time, particularly cosmetics or some of the sort of maybe more items you see at the pharmacy than items you see at the grocery store.
Okay, that's really, really interesting. I think we will leave it there. Andrew Hall, I just want to thank you for taking us through these three different sectors. Is there just a final thought you want to wrap up with any of the, I don't know if anything sort of wraps all three of them up, but is there anything coming for either consumer staples, utilities, or telecom that we want to watch pretty closely, that you're watching pretty closely?
I mean, I think that, as we sort of highlighted, these are three of the ways you can try to be defensive in the market. And kind of picking between them is sort of what I'm trying to do at any given point in time. And when you think about utilities, there's the broad base is probably doing fine, not consumer sentiment or consumer strength driven at all. It's really government spending, and those are doing fine. There's maybe small little pockets where there's more thematics around AI, data centers, and nuclear. And then telecom, it's been a challenging period, maybe getting a little bit better, but how much better can it really get? And then the grocers, which are just kind of executing well. They've really survived through things, and that's partly reflected in their valuations. Yeah, fantastic. Thank you for joining us. We wish you a great it's not really a long weekend, but a holiday week ahead. For sure, thanks, great to be here.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.